Hey everyone, Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about what some people are referring to as the next big financial bubble. So what am I talking about? Well, specifically, I'm talking about index fund investing and some of the articles that have been written here over the last year or two talking about why index funds might actually be the next big financial bubble. So this thing really kind of came to the forefront here recently back in September when Michael Burry, he's the real life character that Christian Bale played in the movie The Big Short, if you were able to see that movie. But Michael Burry came out with some pretty harsh words about index funding and actually compared index fund to collateralized debt obligations. So in this video here today, what I'm going to do is I'm going to talk about some of the specific comments that Michael Burry made about index funds. I'm going to be talking about where index funds might be able to fit into your portfolio and some ways that you could actually use those maybe to your benefit. And I'm also going to talk about some of the things that we need to be concerned about, some things maybe that Michael Burry may not have even mentioned about index funds that we should be keeping in mind as we're starting to put together our portfolio. So let's jump right in. So one of the main reasons that I wanted to make this video here today, I think, is because of just how popular index fund investing has become over the past couple of decades. In particular, the last decade has really seen an absolute explosion of growth into these index-based investments. And I think that's one of the reasons that Michael Burry is a little bit concerned about this potentially being a bubble. And one of the main reasons for that is because of what he calls the lack of price discovery. So when you have all of this money going into a passive index fund investment, it's going to go into those companies, whether it's the S&P 500 or it's some other index. They're just going to buy all 500 companies if we're talking about the S&P. And what that does is it doesn't give you any differentiation between one company to another. The money goes into those companies and it usually gets allocated just simply based off of the size of the company. So the bigger stocks get the better portion of the money that's going into that, and the smaller companies get a little bit less of the money that's going into that index. So anyway, so it's not giving you the ability to pick the stocks based off of their true merit, the balance sheet of the company, the management, what kind of new products are they coming out with, how fast are the company's earnings growing, but just simply because the stock is in the index, it's getting some of the money's attention. So let me give you a couple of quick examples of this. According to Morningstar here, over the last 10 years, to give you an idea of just how much money has gone into this index fund investments, $1.4 trillion has come out of those active money managers, the managers that are actively trying to buy and sell the securities for their portfolio, trying to get the best returns possible. And $1.3 trillion of that has gone into these passive index fund investments. So almost a net outflow to inflow, money coming out of those active managers and going into the passive managers. And so what that's done is over the past 10 years, we've now reached a point where we're almost at a parity, where we have almost the same amount of money in those passive index-based investments as we have in the actively traded mutual funds. And so I think that's one of the things that I think all of us should be a little bit concerned about. And also be concerned about what index we're buying and what is the makeup of that index and how is that index constructed. Okay, so why have index funds become so popular here over the last decade or two? Is it just simply because they've had some really good marketing? Well, that might be part of it, but I think in particular there's a couple of very specific reasons why index funds have gotten so much of the attention here recently over those actively managed funds. Number one, I think, is performance. So when you look at the performance of those active money managers, the ones that are going out there actively trying to buy and sell securities, trying to get the best return for their client, on average, those funds don't tend to beat their unmanaged indexes in a large way. In fact, there's been studies on this every single year. Morningstar does one. I think the percentages are usually up in the 90 to 95% range, where 90 to 95% of those active managers are not beating those unmanaged indexes. So there's some pretty large numbers, and there's some pretty compelling reasons why just buying the index is something that may make a little bit more sense. And indexes also tend to be much lower fees as well. So you're getting better performance and lower fees, so why wouldn't you do that? If any of you have watched some of my other videos and you've heard me talk about this, you probably know that although generally I'm not a huge fan of index funds, I'm also not a very big fan of those actively managed portfolios as well. We tend to manage most of our portfolios kind of in this middle ground where we tend to use a little bit more of a passive approach to our portfolios, but we use some factor-based modeling so we can pick those attributes that we believe have the best long-term performance based on historical data, things like price to earnings ratio, ratio, a return on assets, low debt, good price momentum. Those are things historically, if you look at the numbers, have led to some above average performance and tend to beat some of those indexes in many cases. And so we kind of take that passive approach, but we think we do a little bit better job at applying some better filters than just simply buying the biggest companies that are out there. Okay, so let's talk for a moment about why passive investing tends to work, and let's talk also about why active management tends to underperform those passive investments. So first of all, if we think about a passive investment portfolio, let's say we're talking about the S&P 500. Basically, the model of the S&P 500 is buy big companies. So they're going to buy 500 of the biggest U.S.-based companies, and they're going to allocate those dollars simply based on the size of the company. But the S&P people that pick that index, they do that with extreme discipline. So they don't care who the president of the United States is. They don't care if we're at war, if we're at peace. They don't care what's going on with the Federal Reserve, if they're raising rates or lowering rates. They just continue to do the same thing over and over again. And that type of discipline is maybe one of the single biggest factors in getting some good performance over a long period of time. So if we think about the active manager, a lot of times they're very, very smart people. In fact, I would say that almost all of them are very, very smart people, having very advanced degrees, usually PhDs, master's degrees from some very prestigious universities, and entire teams of people devoted to going out there and doing research and helping them pick the best securities for that portfolio. So why do they not sometimes get that right? Well, I think number one has to be the human emotional element of this. In fact, I've actually wrote other articles and done other videos talking about this specifically, but it's that human emotion that sometimes can really get in our way. And as individual investors, that can also be one of the biggest detriments to how our long-term success is going to be driven as well, is if we start reacting too much to the events that are going on. We start thinking about tariffs and what that might do to our overall portfolio, or what that might do to certain sectors of the portfolio. The chances of us getting that right and knowing for sure what's going to happen with these tariffs, whether they're going to be put in place, whether they're going to be sidelined, whether or not we're going to get a new president in a year and a half, and they're going to completely change everything that we've known up to this point. We just don't have that kind of clarity with the financial markets. So when we start trying to manipulate this and move things around too much, we tend to get it wrong oftentimes more than we get it right. So I think that's one of the big elements to that. I think also, if we look at a lot of the active managers, they're really not so active because these managers are being paid based on performance, and they're usually being paid based on performance relative to an index. And so with that in mind, they tend to buy a lot of the same companies that the index is owning, and maybe make some small adjustments to kind of compensate for what their personal views or beliefs are with that particular portfolio, what's going on in the economy and that sort of thing. But because they have so many of the same stocks, that net differential, that delta, is really not all that significant. And because of their management fees being higher, that is something that really kind of drags down the performance of the portfolio there. The other reason is that the active managers might have a kind of a different objective than the S&P. Some managers might have a little bit more conservative nature. So they might be looking for maybe lower volatility companies. Maybe they're looking for things that they believe will perform better in a down economy. And so because of that, they may not have the same kind of upward mobility growth that something like the S&P has, which is going to be focused on some of those biggest, maybe some of those fastest growing companies that we have inside the country. Another reason that active managers may underperform the passive counterparts is simply because some of those portfolios get too big. And because the portfolio grew in size, they're not able to be as nimble as they were maybe when it was a smaller company, a smaller fund company, that is. So the size of the fund can also have some detrimental impact on that. And then there also may be some constraints on the portfolio as well. So a lot of times you'll see mutual funds being driven to invest fully their entire portfolio. Essentially, if you buy the S&P 500, that's what you're going to have. You're going to have pretty much 100% of your money invested in the stock market. And you might say, well, hey, isn't that a good thing? Shouldn't our active managers do exactly the same thing? Well, active managers are always going out there trying to find the best securities that they believe that they would like to own for the portfolio. And a lot of managers like to hold a little bit of cash because there may not always be good buying opportunities at every given moment. But because they're being driven to invest that money fully when those buying opportunities present themselves. They really don't have the cash available to go out and do that. So as an example here, using Warren Buffett, he currently, as of August 31st, has about $122 billion in cash in his Berkshire Hathaway company. So that is a lot of money. And basically, he's got a quote that he gave investors at their shareholder meeting recently. And he says, basically, there's not enough good things to buy out there. And that's the primary reason that they're holding that much cash. In other words, he thinks that things are too highly priced. And so you've got Warren Buffett, arguably the best investor of all time, holding onto that significant amount of cash because he wants to get that buying opportunity. And if you look at Warren Buffett's portfolio, although it's been extremely good over long periods of time, over multiple decades, he definitely has gone through periods of time where he's underperformed that index simply because maybe he's held some cash, or maybe the investments that he bought haven't quite materialized to the growth factor that he'd like to see. Back in the late 90s, I remember this very clearly. It was early on in my career, and a lot of people were talking about Warren Buffett as, he's over the hill, he's lost it. He doesn't even have a computer on his desk anymore. And he just smiled and didn't care. He kept doing exactly what Warren Buffett always does, and that's going out buying, good companies at good values. And then when that internet bubble crashed in 2000, and most people remember 2000 to 2002 as being very negative for stocks, Warren Buffett did very well if you go back and look at the returns for Berkshire Hathaway over that 3-year time period. So the constraints that the managers themselves put onto the portfolio can have some impact on the overall returns. So I want to kind of summarize that up here just in this context, talking about those active, versus passive investments. And, it doesn't mean that all active are bad, doesn't mean that all passive are bad. They all can kind of have a place in your portfolio, but kind of understanding how they all operate, and then understanding also too that if you haven't already looked at some of those factor-based models, you might want to consider that as well as maybe kind of that third leg of the stool for your portfolio, where you have different things kind of moving in different directions, maybe at different times. So that's something that could, potentially give you a little bit more diversification, and looking for some of those factors that historically have added some long-term performance to the portfolios. Okay, so let's wrap things up and talk about maybe 3 more risks that we see with index fund investing. So the first one is something that Michael Burry talked about in his interview with Bloomberg, and he talked about the liquidity issues with these indexes. And I think this is something that should be very recognized here as a potential risk. And he talks not only about some of the big companies that have literally trillions of dollars in indexes like the S&P 500, but he also talks about some of the smaller stocks that are within that index. And he goes on, now without getting into too technical of detail here, he goes on to talk about some of the market daily volume in some of those smaller companies, and how, based on the fact that there's billions, if not trillions of dollars that are tied to these indexes, is there going to be enough liquidity if all of a sudden there ends up being a big decline in the market? So this is something I've shown in many other videos here. This is from the JP Morgan Guide to the Markets, and it just kind of goes back to 1996 and shows, some of the trajectory of the S&P 500, and, big ups, 100% up, 49% down, 100% up, 57% down. And now, we're on this leg here going back from the lows of 2009 up over 340% as we sit right here at the end of the third quarter of 2019. So, nobody knows when the next bubble is going to be. In fact, this could actually go up another 300% before we see anything major happen here. But, when that next bubble does burst for the stock market, and we do see declines of 20, 30, 40, or 50% or more, what's going to happen to the portfolios? And indexes in particular could be something that could get hit a little bit harder than some other areas of the market. Another potential risk along the same lines is when we do see this decline in the stock market, one of the things about index fund investing is they tend to have a lot of embedded capital gains. So if we're talking about an open-ended mutual fund, all of the buying and selling of that fund occurs within the mutual fund itself. That's something different than an ETF, an exchange-traded fund. We use primarily ETFs with our portfolios, and the buying and selling occurs outside of the ETF. And in particular, when it comes to taxes, that's something that has a very big impact on those open-ended mutual funds versus the ETF. So if you have an open-ended index fund, when the market goes down and people start panicking, because that's oftentimes what they do, they start taking their money out, that's going to trigger a whole bunch of capital gains. So I looked at the Vanguard S&P 500 index fund, which is the largest index fund, and it has right now about 36% embedded capital gain. So what that means is that that fund is 36% higher than their cost basis is. So if they start having to sell off shares, that's going to trigger a whole bunch of capital gains that could even be in a period when the market's actually going down. And that's something that always baffles people. How can I possibly be paying taxes right now when I've just lost money in my portfolio? Well, it's because they own stocks here for the last decade that have all been doing very, very well. And now because people have asked for their money back, they're having to sell those stocks, and that's what's triggering those capital gains. So anyway, I hope this video has been helpful. I hope it kind of gave you a little bit of light, just talking about some of the risks out there. Again, this was not intended to completely bash the index fund world out there, but kind of just make you aware of some of the potential risks there. Talking about active, talking about that factor-based approach that might be kind of a little bit of a hybrid between the two, and how you would necessarily design your portfolio. And remember, probably one of the biggest risks that all of us as investors have is panic. And so when we see the market going through these negative downturns, do we have a plan in place to deal with that? Or are we going to watch things go down and watch it go down 10% and 20% and 30%? And do we have a mechanism to be able to pull the trigger and say, hey, we've got something that, we're going to shift into our defensive mode in our portfolio? That's something that we do with our clients. We have a very specific way that we go about doing that. It's called tactical investing, and we look at a number of relative strength and momentum indicators. Not a crystal ball, but it tries to give us an idea of where some of these major markets might be going. And also keep in mind too, especially if you are indexing, there's a lot of indexes out there. In fact, Investment News, I couldn't even believe it when I read it, but they actually said there's more indexes out there than there are publicly traded companies. So if you can imagine that, and there's an index for anything that you could possibly imagine. So over the last decade here, it's been very, very good for U.S. investments. Historically, international investments have done better than U.S. Now, U.S. is about half of the global economy in terms of the world stock market. So if you haven't considered those international investments or how they fit into your portfolio, that's something to think about as well. And the valuations on the international markets are much better right now if we're looking at things like price to earnings ratio and things of that nature. So it doesn't mean that you should go and jump both feet into the international markets. In fact, our portfolios right now, this is November of 2019, we're still very underweight international, but there will be a time where we will pick up that international exposure. And how do you best do that? Is it through an index? Is it through some type of factor model or an active management? So that's just a couple things to think about there. So anyway, I hope you enjoyed the video. Hope you got some great value out of it. Remember, if you haven't already, be sure to subscribe to our page. Also hit that little notification bell. That way, anytime we upload something, you're going to get an instant notification of that, so you won't miss any of our videos. Also, too, we're rolling out our resource center, where we're going to have some additional videos and content that's not available here on our YouTube channel. So totally free to join that. Just click on the link below and you can sign up and get access to all of those other videos. I've got a great vision workshop where it takes you through, if you're planning for retirement, just how to kind of get things in order for retirement, figure out what direction you're going, and help you put together some of that initial planning. So anyway, with that, have a great day, and I'll see you back in our next video. Thanks.